Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Alrighty, welcome back. How is everybody doing out there today? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding Podcast. Jeffrey Gannon, how's it going over there?
It's going good, Andrew. How's it going with you?
It is going great. We hope it's going great for everybody as well. If you do want to follow me on Twitter, go to your Twitter app or the Twitter.com domain and follow me at Focused Compound. If you want to email Jeff, get into contact with him about anything investing related, feel free to email him at gannoninvesting@gmail.com. We also manage accounts for investors and other advisors. We can say that now. Okay. Feel free to email me if you're interested in that, info@focusedcompounding.com. Okay. That's it. If you want to complain about something, email Geoff Gannon. Just kidding. So today we're going to be talking about Warren Buffett's Berkshire Letter that came out recently. Okay. And you liked the letter. You said it was a little bit different than the past ones. And
yes, very different.
And it was. And we could definitely go over why. And, this time of year is great. It's like Charlie Munger does his daily journal meeting. And then, he was on CNBC. And then Warren Buffett comes out with his letter. And then he was on CNBC. And, I got to soak it up. Charlie Munger's 95 and Warren is he 88 now or 87?
88, I think.
88. So it's pretty incredible to see them still sharp as ever.
Yeah, so you, not this year, but in the past, you did go to
I did.
Munger. So you saw Munger in person.
Yes, and I was upset that I did not go this year. And it's kind of like the best kept secret. When I was there probably, I don't even know, 100-ish people. And I'm pretty sure this year was way more than that. They needed a bigger room.
And so is that in California?
Yep.
All right.
Yes.
So what was that like?
It was incredible. Yeah, it was, same thing. You kind of get a lot of the answers are the same, which is kind of great because they, I guess, still think the same. But it's just cool to hear it, straight from his mouth and kind of see him and be there in person. And what's most fun is meeting other investors, people on FinTwit and, other investors that you know about, and then seeing them in person. I saw Monish and, there's just, it's fun. It's just a bunch of investing junkies in one room and listening to the guy preach. So it's always a good time. It'd be fun to go to the Berkshire meeting itself too, but
a lot of people go there to network and stuff, but you can't see it online at
I was gonna say now that they do it on Yahoo, that's have to go all the way to Omaha to do that.
Well, I think they didn't have a venue big enough anymore. I mean that they were basically had more people wanting to go than could be there. Also, I think airlines and hotels and stuff got to be difficult. Omaha is a big city, but it's not
that big.
It's not New York.
Anyways, so we're going to be going over the Berkshire Letter, and we could just kind of go through what you thought about it. They have an equity portfolio valued at $173 billion at the end of 2018.
Yeah, and Buffett manages probably 150 billion of that.
Yeah.
Can you
imagine having to allocate that much capital?
It's difficult, and he talked about that in the interview that he did. So on the Monday after the letter came out, he did an interview on CNBC, and I think he's been doing that for at least a decade. And so he talked about some things in that, and he talks about how difficult it is. People don't believe that; they think it's easier.
Everyone a lot of people like to kind of poo-poo his record, and I get it. Like it's not as good as it's been, or like as the S&P 500, but it's like how can you allocate that much money?
Well, he talked about how his record and those of the two people. Todd Combs and Ted Weschler, who also have portfolios. I guess those two each have about $13 billion or something. I think they said they manage. Have since they started out done a little worse than the S&P 500, and he's done worse than that. He said in his equity portfolio. So they've had trouble beating the S&P 500 since the recovery, basically.
Well, it's been tough when markets go straight up, right?
Yeah, I think the last 10 years or so has been about the toughest time for anyone to beat the S&P 500 that I can think of.
One thing I thought was interesting, and I'm kind of curious to get your thoughts on this, was he spent a lot of time talking about, I guess, sort of like the economics behind repurchasing your own stock.
Right.
And it's almost like I get the impression that he's just kind of like educating his I guess, partners or his shareholders or people who are reading it all about repurchasing stock. It's like, is that what he's going to want to do, is, buy back a lot of Berkshire stock?
That's the impression that I get, yeah.
Yeah.
That's the biggest reason probably for dropping book value. So since, I don't remember what letter they started doing it in, that they started reporting it, but going back, they have it from, I think, 1965. They report the change in book value each year in a big table at the beginning, right before the letter starts. And then the first line of the letter has always been what Berkshire's change in book value was.
Yeah.
And they dropped that this year. So that's something that they dropped for the first time in over 50 years or something. So that's a huge deal. And the logical reason for why you would do that is if you planned to buy back stock above book value.
Yeah.
Yeah.
And then he went on to, of course, bash adjusted EBITDA, which he talks about a lot in stock ownership. And then he went back into the repurchasing. He demonstrated it by talking about their holdings in American Express. And he said Berkshire's holdings of American Express have remained unchanged over the past 8 years. Meanwhile, our ownership increased from 12.6% to 17.9% because of repurchases made by the company.
Yeah. And American Express buys back a lot of stock. Yeah.
I was just super surprised that he spent like the whole letter talking about buybacks.
I think that's the reason why he laid it out. And in the interview, he mentioned that that's the sort of thing that he thought about. Is he thought of it from the perspective, well, what if my sisters who own Berkshire stock said, oh, well, if Berkshire's buying back stock, should I sell? And so he thought, okay, so let me explain why you should or shouldn't. Yeah.
So what did you think about the report?
Well, I thought it was the best letter in a very long time.
And why?
Well, it did two things that were very important. It talked about the logic of buybacks and the reason for not using book value, which has made sense for a long time, why Berkshire should move away from using book value. And then the other thing that it did is it talked about the importance of breaking how to value the company down into, I think he broke it down to 5 groves, he called them. And I think that makes a lot of sense in terms of having to come up with your own appraisal. I've seen lots of people appraise Berkshire, and some of the appraisal methods that they use I don't think are that smart, including some which take out the liabilities that they have for the insurance business, whereas I think that you need to count the insurance business in terms of just funding the other things. Berkshire's insurance business has had an underwriting profit almost every year for a very long time now. It's had like 1 or 2 losses in, 20 years or something. So when you do that, it means that effectively Berkshire is being paid by policyholders to hold money on their behalf. It's sort of like if you had a bank where you were paying the bank interest. And for that reason, it makes sense that the liabilities that insurance company has, those insurance companies have, are really economic assets. And he sort of talked a little bit about that, which I think is important. Because most of the calculations that I had seen years ago people do for how to value the company really were valuing it more like a liquidation. So they relied more on book value, and also as if the liabilities in the insurance business should be taken as liabilities instead of valuing it more like a bank or something where you would realize that the deposits are how you make money. So I thought he did a good job with that.
What did you think about what he talked about? If you were to invest $1 million in, in the S&P 500, a low-cost S&P 500, like way back when, that it would be worth today $5.3 billion. But if you had a 1% management fee on that, it would be $2.65 billion.
Yeah, that's true. Over a long period of time, he talked about that. Yeah. And that's important. Of course, Berkshire's results are a lot better than that. The management fee thing is a big issue. The big issue is just how high you compound at.
Sure.
So you need to get a performance that justifies the entire amount of the performance fee. For the average person thinking about investing in the S&P 500 mutual funds or something, getting a very low expense ratio is the best thing to do. But investing in Berkshire is a much better decision.
I was just going to say, why wouldn't people just invest in Berkshire over like the S&P 500?
I don't know.
Is that what you would do, or what you would suggest people to do? Yeah, that's what I always do. Instead of buying the SPY or SPX or whatever, just buy the Berkshire B shares.
We won't get into how cheap I think Berkshire is versus other things too, but I will also say I think Berkshire is cheaper than the S&P 500 right now.
Why do you think he has so much cash? A lot of people always say follow what he does instead of what he says.
Yes.
He's always talking about how America over the long term is going to do great, and it's probably true.
Yeah.
Right? And it has done great. But why do you think he's holding so much cash? Is that because it's hard to deploy it? I mean, that's probably some of it, right?
Mm-hmm.
But do you think he's waiting for some sort of sell-off? Or what do you think by that?
I don't think he's waiting or timing things. I think he just sees that everything's too expensive.
Yeah.
Yeah. I mean, if you listen very carefully to what he says, he's pretty much saying that.
Mm-hmm.
You know, he said that his, you know, competition with private equity, for instance, is difficult. That private equity will pay more for a company than he'd be willing to.
Mm-hmm.
He mentioned in the interview that there was a big deal that he was hoping would happen in the fourth quarter to buy an entire company, and didn't happen. So there are some things with that, but they probably have about $80 billion that they could use right away. So they're basically sitting on that. There's some cash that they have that they want to always keep on hand. But certainly without borrowing, they could do an $80 billion deal. Mm-hmm. And then you could borrow on top of that too, at least temporarily and stuff. So, and I think Charlie Munger, you know, mentioned, I forget if it was at the past annual meeting or somewhere, where he said that he'd be a lot more willing than Warren to leverage that up if they found the right deal. So he'd be willing to go well over 100 million, you know, to 100 billion to closer to 100 to 150 billion or something.
Mm-hmm.
So they could do a really, really big deal. But you think about how many, you know, companies have that much. To give you an example, Apple is sitting on a similar amount, actually a little bit more probably, in terms of in cash, cash net of debt. They also have some debt, but you know, excess cash they have is even a little bit more than Berkshire probably right now. But other than that, who around the world is? No one really.
Mm-hmm.
So that's the issue that you have, and Apple will probably deploy by buying back their own stock. Mm-hmm. Apple's never been able to find something to acquire, to soak up the cash, so they have that same problem.
What did you think about Warren's interview that he did? Was that with Becky Quick?
Yeah.
What did you think about it?
Good.
Did he talk about? I didn't watch it. Did he talk about the whole Kraft Heinz debacle?
Yes.
What did he say about it?
That he paid too much for Kraft, but did not pay too much for Heinz, he thinks. So the history on that is that Berkshire and 3G went kind of 50-50 partners in acquiring Heinz, the ketchup and other things company. And then they Kraft had split off part of it to Mondelez and the other part to Kraft. Yeah. Kraft being this sort of slower growth parts of things, and then Heinz acquired Kraft, and that brought Buffett's Berkshire's interest in the combined company down closer to 25%. I forget if it's like 27% or something. But so as a result, he said that what he was saying basically is that Heinz paid too much to acquire Kraft. The company is now called Kraft Heinz, but it was really Heinz acquiring Kraft, yeah. Mm-hmm.
What do you think about how he talks about, because of the new book value or the new accounting rules, how the disparity in earnings every single quarter?
Yeah, it's a terrible rule.
But why did they do it?
There's the mark-to-market thing's always been attractive from an accounting perspective, from a regulation perspective. They've always adopted the idea that mark-to-market's good. I don't know if mark-to-market's always good, but it has good aspects to it, in that it gives less discretion to management, I guess. But it's very problematic that way. For at least, 40 years or so, Berkshire has, for accounting, was it 40 years? I don't know exactly when it was, but it feels like it to me. They've been using, they mark to market their stocks for book value purposes.
Yeah.
Before then, actually, in the very beginning of Berkshire, they would have carried their stocks because they were an insurance company without even marking them to market for balance sheet purposes. But what they do is they don't pass that through the income statement. Now, what people pay attention to is not the comprehensive income, which instead most investors pay attention to net income. I'm not sure if that's a smart idea. Most investors should probably look at comprehensive income too and look at changes in book value and understand the differences between them, but they don't. So as a result, now people won't be able to strip out the changes in the portfolio versus the results that Berkshire reports each quarter. So the headline number you see each quarter will be pretty meaningless.
Yeah, sure.
Yeah.
What do you think is going to happen in Berkshire in 10 years? I don't want to say. I don't like to say when Warren and Charlie are gone. I think it's a little. But what do you think Berkshire's going to be like?
That's a good question. I don't know the answer to that. I mean, we have a pretty good idea of who will be involved in running it.
Yep.
There's two people who've been, one put in charge of all the insurance things and one put in charge of all the operating businesses. And then we also know that there are two other people who are, like I said, each managing $13 billion. Presumably the people who are each managing the $13 billion would basically be managing all of Berkshire's stock portfolio. The person that you have in charge of the operating businesses would basically be running that part, and then you have someone in charge of insurance running that. So that's pretty simple to understand. And then you need someone at the top, which would presumably be Warren's son, Howie, who would be
who's also he's on
the
the board,
non-executive chairman, or whatever they would call him. Yeah, and he would act as the chairman. Basically, the reason for that is, I assume he would, by having someone who has the Buffett name and things like that, he could be involved in replacing anyone that they had a problem with. So the reason for having a chairman like that is basically to help in succession, because at some points you could have a scandal that you need to get rid of. Someone that happened with Sokol, who they had, who was an important manager at Berkshire previously. So something like that could happen. People can die, they can retire, they can quit, or they can just not work out. So there will be some Buffett still on the board. And then you have probably those four people being the key people. I would assume there's more separation between the insurance business and the operating businesses and the investing, which is the three things that Buffett was involved in doing. So in terms of capital allocation, I assume they'll just buy back a lot of stock. I don't know if they'll pay a dividend. That's something they've talked about.
No, I think I kind of get the impression I think they're going to buy back a lot of their stock and then kind of keep it going as usual, but they're probably going to buy back a lot of stock. What do you think about the stock price, how it's going to be on that day? Is it going to be like Apple? Remember what happened with Apple when Steve Jobs died and the stock just like plummeted?
Okay. That's a question that people have. He always says he thinks
it's going to be a non-event, right?
Yeah.
I could see him like having like a video where if it like the stock like crashes afterwards, he'd be like, look, I'm dead, but everything's okay. You know? Not laughing at that. I'm just saying.
Yeah. I don't know. That's a very hard thing to know. I don't see any reason why it should drop a lot. Buffett's become less and less important to the company over time, not be for any reason other than just the size.
Sure.
So like we talked about the equity portfolio things, like when people asked about, well, how much is there, when I'd talk to people, they would say, well, there's this Buffett premium in the stock and stuff, which I don't believe is true. But
you don't believe that's true?
No. The Berkshire doesn't trade above...
I was going to say, it's not trading.
What?
Was it below book value? Or
No, it's above book value,
1.3 book value.
No. But Berkshire right now is cheaper than the sum of its parts. If you split off its parts and sold it to private equity and stuff, it would go for more than it is. I don't trading at. I don't think that. I think the reason why it is does not trade at a premium is because it's a huge company which can't be taken over and which is, he said many times, has no intention of breaking up and stuff. If tomorrow you heard that Berkshire was going to break up, I think that people would start bidding up the stock incredibly high. There's no quick buck to be made in the stock.
Sure.
So I think that's why it doesn't trade that high. So why it sometimes trades cheaper. And I think we talked about the period where they've underperformed the S&P 500 in terms of the equity portfolio and stuff in these last 10 years. But I think in these last 10 years, Berkshire's often been pretty cheap versus what I think its intrinsic value is, and that hasn't always been the case in the past.
They actually talked about that as well in an article, that they think it's cheaper than their estimation of intrinsic value.
Yeah, it is cheaper.
And he said that multiple times.
Yeah.
Now, how do you go about trying to figure out the intrinsic value of the company? Because I've seen a bunch of different ways that people think about it.
Yeah. So the first thing, you think of it as a fund, basically, and the first thing you do is you don't think of it in terms of liquidation or applying like a discount to it, which people sometimes do. You think of it as an ongoing business. So you try to figure out what its value is and how much it'll compound in the future. He talked about the 5 groves, which I guess are the insurance business, the operating businesses, which are not insurance businesses, the equity holdings that they have, and then they also talked about for accounting purposes, the things that they partially own, which are a little more complicated, like Kraft Heinz. So they don't mark Kraft Heinz to market the same way that they do smaller stocks. And then the last thing I guess would be the like cash and similar things, so like short-term bond things. So that's easy. The cash is worth what the cash is worth. The equity portfolio you can take at the value of the equity portfolio. That's fine. I think that the equity portfolio won't perform that well in the future, but I don't think the S&P 500 will perform that well in the future. That's why. So then you look at the insurance business. It's a great insurance business. It's one of the best in the world. So that's the part that most people undervalue. And then you have the operating businesses, which are, if you looked at the results, are pretty good. And you can try to value them. You have a railroad there, which is the most important part is the railroad and the utility business. Those are the two most important. The railroad and the energy business. And that accounts for a very large part of it. And then you have a mix of the other things. I mean, he goes through the letter breaking them down, what they're worth. And you would just apply multiples to each of them. You'd say, okay.
So literally do a sum of the parts kind of analysis with it, yeah.
You'd say, is this worth 15 times earnings, 20 times earnings? What's it worth, you know? And if you do that kind of math, you'll see that it's pretty cheap. I mean, one way to compare it is think about the S&P 500 or many stocks in the S&P 500. What do they trade out versus book value? Even take something like, okay, so there's a huge insurance business. What do many huge insurers trade at versus book value? Like for instance, they have a very big business, Geico. It's not their biggest insurance business, but it's big. When we talk about book value, people have to understand what Progressive, Geico's most similar competitor, trades at in terms of book value. Progressive never trades anywhere near book value. That would be incredibly cheap. You would want to buy Progressive if it ever gets anywhere near book value because it's an excellent business, and Geico's an excellent business. They have an underwriting profit, plus they grow float a lot. The quality of the insurance businesses are very, very good, and that's one of the biggest reasons why the stock is undervalued, is that I think the market generally undervalues the insurance businesses. Yeah. And
then you wouldn't put any, like if you're thinking about its future, you wouldn't put anything into it about Buffett's and Munger's future being being a part of Berkshire?
I don't think it matters as much now as it used to, because as you saw, Buffett couldn't outperform the S&P 500 over the last 10 years, and the reason for that is that he was managing $170 billion instead of $170 million. If he was managing $170 million, he could have outperformed.
Yeah.
Yeah.
So you just kind of factor that in
I don't think that it mattered.
I'm just saying, like, you're not expecting them to outperform is what you're pretty much saying.
Correct.
Got it.
And I think I wrote something about it, I don't know, 10 years ago or something. And at that point I was saying, it's a very small difference now. It has some advantages because of buying entire companies.
Yeah.
Which whoever is running the company after Buffett and Munger are gone won't have the same ability to buy an entire company.
You don't think like the deal
flow won't be as good? Yeah. No, because some people will sell to them to sell to Buffett,
because he's just a famous investor.
Right. So, like for instance, like Luxottica did a deal where Luxottica merged with Essilor. Their family was looking for a way out. Basically, the person who founded it and ran it for all that time didn't really want to pass on operating control and stuff to his kids. So he needed a way out, right? And he merged with their biggest, he was the biggest eyeglass frame company in the world, and he had always been the company that was the biggest lens company, had always wanted to merge with them.
Sure.
So that's what he did, and that was his way out. But people in that situation of this huge, really good company that they founded will often think of Buffett, but would never think of just selling to private equity. Right? They think of it as like a safe home that way. Yeah. It's the kind of thing that at the end of their career they might think about a merger or a deal to sell to someone where they would not sell to I don't want to name any of them, but any of the private equity firms you can think of, because they would go public with them again in 5 years or something,
Sure.
Whereas Berkshire is going to hold on to them forever.
Yeah. Interesting. Cool. Well,
and there was some deal that we don't know about that he
I wonder what
considered.
That is.
It was obviously a big one. I mean, I think there have been Buffett has probably looked at deals that are bigger than anything that Berkshire has done yet. That's the impression I get from that statement and a couple other ones he's made in the past, and they don't work out. But it is possible that one day.
You think it's because they just can't come together on a price?
Probably.
Yeah. One day though.
Yeah. So, I mean, and he talked about in the interview, how quickly he spent so much money in 2008. He said too quickly, because as it turned out, the prices kept going down. He would have been better off. But that's true. If you had a panic or something like that, and who could have predicted that before 2008?
Sure.
But yeah, right now with where prices are and everything, it's very hard for them to spend it. I think the primary thing that they'll do long term, if we're talking about where do I think they'll use most money for the next 10 years, I think it's buying back their stock.
Yeah. And that's the impression that I got from from this letter. It was a lot of education on buying back the stock and what that means for the shareholders.
Yeah.
No, I thought it was great. And for anyone that is interested in the annual meeting, it is going to take place Saturday, May 4th. What I like to do is wake up and, pop on my TV, Yahoo Finance, and it's a lot of fun. And a lot of it, like I said, a lot of it they've answered before. I mean, you could go back to like the vault, right? Back to like the 90s, and they were saying the same stuff. But I think that's almost the beauty in it. And, as they get older, I feel like as Charlie gets older, he's a little bit more honest, which is always a lot of fun. And I really love watching it on Yahoo Finance. So you can do that and keep or put that down on your calendar. I want to thank everybody for tuning in with us here today at the Focus Compounding Podcast. If you want to get access to Geoff's memos that he does send out, we send out every single week. Go to focuscompounding.com. There's a free part on there, and that'll put you on our email list, and that will allow those memos to go to you every single week. If you do want to sign up, be sure you do use the podcast promo code, which is podcast, and what that'll do is take money off of the monthly price every single month. And there's also an annual option on there as well.
Yeah.
There is. And follow me at Focus Compound.
Mm-hmm.
Geoff, I want to thank you so much. Everybody else, have a great week. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.